15 markets have opened, and it's a big day because Reliance AGM, then you've got a block deal in Zomato, you've got a block deal even for that matter. Reliance ahead of AGM is flat 5 rupees, Zomato block deal 3% higher, and then another block deal in Star Health 12 rupees higher. Where is Jio Financial Services? Yes, no, a lot of yes, no is happening in Jio Financial Services, index selling on one side, but finally it's not circuit down. So if the stock is not circuit down, it clearly means that, right now the index selling seems to be, getting out of the way. Then let's mark some newsmakers. One newsmaker over the weekend, I would say to some extent, not too many stocks in news, but it was Bajaj Finance and Bajaj Finserv. Let's look at it. L&T, the annual report has been dissected, threaded by Morgan Stanley and by CLSA, so that surely will have an impact going forward. In terms of a theme, I would say the theme last week was power. It was at, certainly not at 220. And certainly not at 440, somewhere in middle, but power stocks were accelerating as if there is no tomorrow. NTPC, Power Grid, you got REC, PFC, smaller power companies like Reliance Power, JP Power, just about everything in the power space was on a tear last week, and it's off to a good start. But more than anything else, Aisha, I think we are exactly in line with what the global setup is, and the breadth of the market is looking powerful enough again.
Yeah, it is. Much unlike what the GIFT Nifty was indicating, it is a mildly positive start only. We are not seeing as much cheer as our global counterparts are. But nonetheless, we've made it back to that 19,300 print. Let's see whether we can scale it up higher to closer to 19,500 as we did in the week gone by at the higher end of the range. The big contributors are autos are looking okay, financials as well are doing okay, and even metals are actually staging a comeback as we can see in the prima facie trends right now. BHEL, the order that they've bagged from NHPC, let's check in on that stock, 2.5% of a big move on that. BEL as well. Sizable quantum of orders in the last 2 months, 3,289 crore rupees. So look out for what that as well stock does. There's of course BEML as well. They've bagged orders worth about $19.7 million from Russia. So look out for that stock too. And then of course there's Jio Financials as well, wherein Motilal Oswal Mutual Fund bought 3.72 crore shares. Right now it's holding up in the positive, 1% higher. Reliance should come up for you on your screens next. Let's see where that stock has settled in at ahead of its AGM. Absolutely flat, a no-go literally at 24.71 on that stock. Indostar, they've sold the corporate portfolio worth about 915 crore rupees to Phoenix ARC. This is going to be an important stock to look out for as well as after the analyst meet. There are a couple of other names. Let's check in on what a Paytm as well is up to, considering Anfint share, sold a 3.6% stake at a price level of 895.20. Paytm a little bit tempered in trade. And then of course some of these rice stocks as well. The government has now introduced an additional safeguarded basmati rice exports. So this may not be auguring all that well. KRBL sharply lower, 3% right now. LT Foods is the other one, which should come up for you on your screens. But a very tempered move, Kunal. A, can it pick it up? And B, what trades are looking lucrative right now?
Yeah, I doubt that whether it'll pick up on the indices. I have my reservations over there because my belief is that, we could probably be facing into a big resistance zone this time around. So we'll need to see that what sectors, which stocks they manage to bounce back to really determine that whether this could be a bounce back which could last, as well as start off a new trend for the indices. In terms of an opening trade, Bajaj Finserv is something which looks very attractive at 1500 levels.
All right, let's find out what Naresh's first trade is as well. And Naresh, you were tilting towards the financials when it came to your top recommendations. Is that the first trade you're punching into?
Yeah, continue like Bandhan Bank. That's a stock which has done well, expecting it to continue.
Okay, block deal in Zomato, and this is one of the topics of Jeffries also, I think. And Chris Wood wrote in his portfolio that you need to buy Zomato. When I spoke to him, he also said that look at the size of the country and look at the market cap of Zomato. It really can go a long, long way. Mahesh Sindurkar joins us, Head of Research and Managing Director with Jeffries, and we'll take the conversation forward on where markets are headed and how does he map the risk-reward ratio. Mahesh, good morning. Thank you for joining us. Mahesh, what's your market view after the recent rally? Is it time now for markets to consolidate, or the upside in the market is still left in the near term?
Yeah, I think the markets have had a decent run, and my sense is that is not simply because of that reason that I think there could be a consolidation phase ahead, but also the other global risk that we need to keep in mind is the significantly higher U.S. Treasury yields, right? I mean, the risk-free rates in the U.S. have gone back up to the peak levels that we saw back in March. So when you are able to make a 5% risk-free rate, in the US, then that's obviously going to be something that will put equity valuations all over the world into a question mark. So that's one thing that we need to keep in mind. Also, from the India standpoint, I think the Indian inflation itself was, a big negative surprise. The last print that is, and my sense is that the inflation will probably stay at an elevated level at least for the next 1 quarter or so. So that will also push out the rate cut probabilities that some people were building in for the near term. So I think, yeah, those are the reasons why I think there could be a breather, there could be a consolidation phase in the market over the next, say, 1 to 2 quarters or so. But from a medium to long term perspective, things are looking very attractive. The capex cycle is unfolding. Economic growth is clearly standing out in the global context. So I think on that front, yeah, we are clearly very optimistic.
Mahesh, history indicates that if you buy markets at these juncture based on historical parameters, the returns in the long term, they get compromised, which is that rarely if you have bought market at 17, 18 times 1 year forward, you made double digit returns. Do you think this time it could be different? Largely because the India narrative this time is very different, the construct of global equity is very different, and what has happened in the past may not happen in the future?
Yeah, good point, Nikunj. The thing is the benchmark for valuations have actually got changed, I would say, over the last 5 to 7 years. Not just in India, but I would say in the other parts of the world as well. So on an absolute basis, yes, the Indian market does look expensive compared to its own history over the last, say, 10 years or so. But if you take a look at relative valuations, as in relative to other emerging markets, other developed market, other Asian markets, etc., and yes, India is at a premium, but that premium is more or less at the average levels that we've seen over the last decade. So yes, on an absolute basis, the valuations are looking on a higher side, and your point is valid. But I think that valuation benchmarks have got changed globally and not just in India. And therefore, any global possible sort of correction in the markets, I think remains the key risk that we need to watch out for.
Paresh, wanted to understand, what do you think is driving mid-caps forward? And, I was just looking at your recent note where you think capex in housing is actually driving demand there. Elaborate a little bit about this theme to us.
Sure. So we do like mid-caps, small caps from a, once again, a medium to long-term perspective. And our preference and the reason why we like mid-caps is not because of the market capitalization. Necessarily that we like small caps or mid caps, not that. I think we like mid cap and the small caps for what they represent. I think the mid caps and small caps are truly representing the India story, especially in the context of the capex cycle upturn that we're looking at. See, if you look at the large cap names, large cap indices like Nifty, etc., you will barely see, just about 5% of the large cap index weight is in the stocks that are geared towards the property upcycle, the capex upcycle. But if you look at mid caps and small caps, that number goes up to 20-25%. So, also the proportion of domestic oriented stocks is much higher in the mid caps and small caps. Whereas in the large cap indices, you have several large commodity names and IT names and pharma names, etc., where the outlook is not necessarily as bright. So, yeah, so just to kind of make my point, we like mid cap, small caps because of what they represent, and they represent the true India story, and those stocks represent the industrial and the capex recovery story as well.
Interesting point that you are tactically overweight on staples. Now, just for the benefit of our viewers, staples essentially means you are bullish on FMCG stroke names like HUL, Britannia, that category. So Mahesh, I wanted to introduce the meaning of staples for our viewers. Now, your view. Why are you overweight on staples? I mean, I thought they were expensive.
Yeah, sure. I do get asked this question quite a lot. So our structural, overweight ideas are on the banking side, the property side, the industrial side that we just spoke about. Staples is more of a tactical overweight for us, something that we would view to overweight, from the, let's say, the next 6 to 9 months perspective. The reason for that is twofold. One is that we believe in the rural recovery story. We believe that the rural markets have been weak for pretty much the last 2 to 3 years due to the pandemic impact, etc. But we are seeing slow signs of recovery over there. I think staples is one of the ways to play that. Secondly, we also expect that running up to the elections, we have seen some announcements coming from certain states, and I generally believe that running up to the elections, there could be some good news coming for the bottom of the pyramid as well. So I want to play that angle as well. And finally, staples is also a sector where we are clearly seeing the benefit of lower raw material prices reflecting in better EBITDA margins. So those are primarily the three reasons. But having said that, I would say that this is still a tactical bet. This is not a sector that I would buy and hold with a 5-year view.
You've expressed your thoughts on banks, but I want to go back to the price performance here. Whatever could go right is going right for financials. NPAs are low, credit offtake is strong, retail is picking up, there are no delinquency whatsoever, great managements are at play right now. Just about every bank has a good forward-looking CEO. Yet financials per se in this year have not given great returns. So is this one of those cases where everybody is bought into financials, and now what else could go right, and that is the reason why financials will not go in terms of stock performance?
Yeah, absolutely right, Nikunj. I think you hit the nail right on the head. Several good things are happening, and not just the ones that you mentioned, but also from the valuation standpoint. It is the only sector where the current valuations are in line with historical averages. For most of the other sectors, the current valuations are much higher. So even from the valuation standpoint as well, the private banks and the large banks are looking, quite reasonable. I think one of the key issues that we are facing at this point in time, and why the banking sector hasn't really done well, is the over ownership. A lot of people who could have bought have already bought. We're already seeing overweight in the domestic, mutual fund insurance sector. We are seeing foreign investors are also overweight on banks. So we definitely need some incremental flows at the broader level for the sector to perform. But having said that, if you look at the stark difference between the large cap banks, I mean, the last 12 months or so, the large cap bank index is up like only 6%. Many of the other segments of the financial stocks like BFSI stock, be it the small finance bank, be it the NBFCs, or be it the small private sector banks, they've all gone up by 60-70%. So there is a huge gap that has got created, and I believe that banks is ultimately going to be one of the ways in which you can possibly play the capex story in an indirect way. Also, the other concern has been the pressure on the net interest margins, and the NIM margins are soon going to be bottoming out. So that's the other thing that we're watching out for. So yeah, on an overall basis, it's a sector that is looking very, very attractive from fundamental as well as valuation standpoint. So that's the reason why we have actually recently raised our conviction on the on the large cap banking space. In fact, we note that out of the top 6 large cap banks, 5 of them are trading below their historical averages. So I think that makes a case for decent return, because ultimately we're looking at most of these banks delivering an 18 to 20% ROE as well.
You think the exact opposite is playing out within the IT sector, that whatever could go bad has gone bad?
That's right. And the stocks are holding up. So once again, I would say IT could be a good tactical bet in the near term once again, because as I mentioned, I do expect some flattish movement, sideways movement, maybe slightly a weakish trend in the broader markets, and in that context, staples should outperform. IT would also probably be a sector where you will see some outperformance over the next 1 to 2 quarters. But once again, that's going to be a tactical bet for me and not something that I would buy and hold with a, as I said, 2-3 year view.
So Mahesh, if a new client walks up to you, he said, look, I've been going to China, but I want to invest in India now. But there's a risk of election cycle, which is a genuine risk in terms of volatility. Should I wait for the election cycle to get over and then come at higher levels with little risk? Or should I take the risk because the earnings are going to be so strong and supportive that the event of election will be overlooked?
Yeah. So I think you're right. What is happening at this point in time is a lot of large global funds are taking that approach of waiting, on the sidelines. And that's visible in the numbers as well. I mean, we have seen that pretty much from September 21 till March 23, a long 18-month period during which we saw the foreign investors net selling Indian equities to the tune of around 37, 38, close to $40 billion. That's a very large selling. Yes, we have seen some net buying since March over the last 5 months or so, but that's been very kind of narrow buying as such, and not really broad based. And we definitely see incremental interest coming in from global mandates or global investors, not the investors that are looking at Asian markets or emerging markets for long. In which case they have been allocating certain part of their portfolio, 15 to 20%, something like that, to India for a long period of time, and they've been tracking India quite closely. But it's the global funds that have not been tracking India very closely for for last 10, 20 years or so, because India was a relatively smaller part in the global context. It still is, but the importance is clearly rising now. India is also the fifth largest stock market by overall market capitalization, and not just the top five in terms of GDP, but top five in terms of market cap as well. And we are seeing large ticket deals getting written out of India. And that's what many of these large global funds do watch out for, because they don't want to come to India and invest like $25, $50 million, $100 million. They want to write slightly bigger checks. And those kind of deals are now possible in India. So we do see incremental interest coming in from there, but many of those are still waiting on the sidelines. But if somebody were to walk up to me to answer your question, I would, just ask them to sort of, close their eyes and buy some of these large cap banks, which are trading at very attractive valuations. And obviously, the other sector that I mentioned is property and industrial. Those are also great stocks to own from a 3 to 5 year perspective as well.
Right. Mahesh, just wanted to get in a view. I don't know if it's fair to ask you, but what about fund flows from India to the US and then China now? We've heard from Jerome Powell on the sidelines of the Jackson Hole event. Inflation continues to be a concern. Similar is the picture for India as well. And then on the other hand, there are all the China bulls who thought valuations are cheap. They pumped in money, and year to date, they've not made any gains. But now with the stamp duty cut coming in, do you think, again, some of the money could move back to China?
See, what we've seen over the last, say, 2 to 3 years or so is that, every 3 to 6 months, there is this, point in time comes where the investors get drawn towards the attractive valuations, which many Chinese stocks are trading at. And, we see some initial spurt, and then, eventually something, goes wrong, and some of those initial expectations get belied, and and we've seen, what kind of has happened to that market. So I think many investors, to my mind, have also gotten tired of this, once in 3 months, once in 6 months type of an event, which has now been happening, for the last 2-3 years now. So yes, there, will probably be, some small, or I would say some near-term attraction towards the theme, that, you just mentioned or you just outlined. But my sense is that there's a growing evidence and there's a growing investor perception that India is the structural story. So yes, maybe in the near term we see some ups and downs and maybe some sideways movement, but I don't think India is going to fall off the radar of the global investors. In fact, if anything, as Nikunj also mentioned earlier, some of the investors are waiting for the to get some clarity on the election outcome. But ultimately, I think India will feature as one of the as one of the attractive markets.
All right, Mahesh, thank you so much for joining in and taking out the time to give us that view on the overall markets as well as the theme that you're really focusing on. Let's shift gears then and put the spotlight on Jio Financial. Do a bit of a deep dive. How does it compare versus its peers? Is it a good long-term bet? What is the outlook in terms of the exposure, and as well as the fact that it hit lower circuit for consecutive days post the delisting? We've got Feroz Aziz, Deputy CEO at Anand Rathi Wealth, right here in our studios to discuss that and lots more. Good to have you. And second largest NBFC in terms of its net worth, Reliance Jio. Do you think that still, when it comes to its business model, that there is a little bit of ambiguity? What's the view?
So if you're going to be demerging a business and then trying to build a financial services business from the scratch, there is going to be ambiguity. If you look at it from a long-term standpoint, you have to understand that it is going to be the most cash-rich NBFC. If 6% of RIL is there, that's 1 lakh crore. We're speaking of 1,35,000 crores of market cap, right? So there are 3-4 businesses in the financial services industry which will surely be a part of that business. One is the asset management business, which they have done an announcement for. If you look at the asset management business, now I'm only touching upon the long term, the short term and the volatility I'll come to. If you look at the asset management business in India is at a very nascent stage. Because out of the total financial services industry or the financial savings of the households, we are just about 6% in equity mutual fund. And if digital is their way to go, and that's why they've tied up with BlackRock, and you would have read about Aladdin, which is one of the BlackRock's digital platform, which has the potential to expand the entire universe of the asset management business. And BlackRock is a great partner because that's the largest with $10 trillion of assets under management. BlackRock has come into India and not been able to take over the entire 100% stake with DSP, and it comes back. So point one I'm making is, if you're looking at digitally reaching the asset management business to the corners of India, that's a business which will definitely be worth a lot more. Today you have a few asset management companies which are listed anywhere between 30-40,000 crores of market cap is what I would say. So from a long-term standpoint, the NBFC business will also be a very, very important business because that's a backward integration to a retail business from a lending standpoint. So long-term, these 3 businesses, asset management, liabilities and assets could be a very, very fruitful mix for a conglomerate like that.
What does that mean for you? Because when Reliance enters something, they will have their own weight, reach, scale, size, and the first thing they may attack could be the distribution channels. Lending business you can't disturb. Why? Because your cost of borrowing would be in and around the government paper. But distribution business is something they can attack. Wealth management business, mutual fund distribution, insurance distribution. What does it mean for the industry per se?
See, I think they may not attack the distribution business. Okay. The reason being, distribution, manufacturing is a far more attractive business at that scale. Okay. Distribution B2C is a very, very different business, right? It's not as lucrative for a long-term, large conglomerate like that. If you're going to manufacturing as a business, like index funds, like Vanguard is the second largest asset management company, right? Cost wars there become very, very easy to play because you have to manage a product, not several relationships. If you're going to manage 10 lakh crores in B2C, the kind of bandwidth it consumes is far, far different than a manufacturing. You have 10 products, you play a cost war, build scale and disrupt the business. Even in the NBFC business, it's possible to disrupt because cost war is the first strategy which generally this conglomerate generally adopts, right? You can have very low NIM aspirations. Disrupt the market because the NIM aspirations of the rest of the NBFCs are very, very steep. In spite of the borrowing cost, if as an NBFC, as a competitor, if my aspiration is to have a 4% NIM and somebody is okay with a 1.5% NIM for the first 5 years of the formative business, I think it can really, really have, and it's a commoditized business. So if somebody is going to lend to me on a consumer durable at 9, that's more attractive than 9.5. So it's a very easy, non-relationship, commoditized business you can disrupt.
So you don't think there could be a price war and nothing would change, let's say, for a IFL 360 or for that matter Anand Rathi or for that matter Prudence, I mean the 3 companies which are listed, you think nothing will change? Because the minute you think about Reliance, it just reminds you of the Jio moment. And that is what markets are worried about. That is what the stocks are also capturing.
See, I'll tell you, these are not the players which are Reliance, which we, like if you mention Anand Rathi, that's a compliment that we will fight them. Definitely not, right? As an NBFC, okay, you're looking at Bajaj Finserv, those kind of large book sizes kind of NBFCs who are in the actual granular lending in the Bharat, not in India, right?
Okay.
And Anand Rathi has presence in 11 different businesses, and their aspiration of NIM of my sister company is 1.2%. So we are anyways not paying the NBFC game. So I personally think that will actually expand the universe more from the asset management standpoint. Asset management standpoint, it's a great news, not just to
Great news for
all the other asset
investors, not
management
shareholders.
asset management companies.
Even
I'll
for
tell you.
shareholders?
How's that?
Okay, let me try and answer that because it'll take me some time to articulate the theory and the hypothesis. Why is it a great news? Because when you're looking at expansion of the pie, in the alpha management, no new client will only buy a BlackRock Geo fund, right? When you expand in the pie in the alpha business, that's the alpha business. Asset management companies are in the alpha business. Wealth managers are in the beta business, managing risk, right? Doing asset allocation. Alpha business, if let's assume I bring a new client from one small little city in East India, right? That guy is not going to forever just look at Geo BlackRock funds, right? But I brought a new investor who will generally have 6 funds in his portfolio. As in his investing journey of 30 years, he might have tasted at least the top 10 asset management companies. So if SBI has about 7-8 lakh crores with about 16-17% market share and HDFC is the second large, if you bring in 3 crores new investors by the digital footprint of this partnership, then the 3 crore investors are going to be there for 10-20 years and they're not going to just buy the fund which actually got them to the platform. And if you look at Aladdin, which is the digital platform, stands for Asset Liability Debt Derivative Network. So it's not a very closed network if you look at what BlackRock has to offer globally.
They're creating an ecosystem broadly, and that's what Feroz seems to be indicating. Okay, my next question is that will investing in India change when such large platforms they take a birth, because they would be about size, they would be about reach, and they would be about low ticket size as well as low charge. And typically that means that index funds, which in India are not as popular as what they are globally, actually could become the port of choice. I mean, the first sip never starts in index fund. It normally starts because your distributor, in a sense, nudges you to buy a small cap fund or a mid cap fund or even a equity diversified scheme. Could this change the needle towards index funds, which in India, by the way, is not that popular?
Nikunj bhai, what I personally think is, index fund investing is very good for a debt kind of an alternative.
Okay.
If you look at 384 active funds in India, the range of return every year they throw up.
They're very precise, 384.
Yeah, that was the last number, which I had, March 31st number, I think so. 384 active funds. If you leave those sector funds and all that, you still have about 179 active funds diversified, fully diversified across sectors. The range of returns they throw up and the cost as a proportion of the range of returns is abysmal. Let's assume I go into an index fund and save a percent. But if the outcome is so different, 38% is the average difference between the best and the worst fund.
38% is the average difference in an equity diversified scheme.
Correct.
In a
a
year.
specific year.
No.
I'll tell you. This is the 4-year data.
Okay.
Last 20-year data is about 27, 28.
So just to break it for viewers, what your data is showing, and very interesting, that in a year, a scheme has given X return, that's a top performer, and the worst scheme in that year will have a gap of 35%.
Yeah.
You need distributors, man.
Absolutely. So in that, if the outcomes could be life or death, I'm not going to go to my neighboring doctor, right? If it is cough and cold, I'll just see who's the closest. But if I'm going to get a bypass surgery, then if the outcomes are so diverse, then cost is immaterial. But in debt, the best and the worst could have 1.5% difference.
Yes.
2% difference. There I'm paying 1% for the best fund manager, giving away half the potential fully. So I personally think if you can apply more mind and choice of funds, the value of that 0.5%, 1% would be very easily recovered. Can it be done by all distributors? The answer is no. I analyzed 700 external distributors' portfolios and 70% of them didn't beat Nifty. So should they actually get into an index fund? Yes. Maybe
70% of the distributors have not managed to beat the Nifty. That's your data.
700 portfolios
700
which
portfolio.
I analyzed,
Okay.
which are with external distributors.
Okay.
If I analyze transaction by transaction, every client does 50, 100 transactions. If they did those transactions in Nifty,
Okay.
would they be richer? They were richer. About 68% of them were richer.
Okay.
So index fund, I can't shun them because everybody is not putting in that kind of energy to identify the 384. Which out of those 384, I mean?
See, in the world of data, like they say, it's only when you look at the data
Anything
you
can
understand.
be proven best and worst.
Oil is the data is the new oil. Now I realize that what data is relevant. Okay, I'll be very specific here because this is a question which keeps on popping up now, and that's about small cap funds now, the risk reward ratio. There are two MCs who've decided not to take lump sum
Fresh money.
into small cap funds. I think Nippon is one, and Tata AIG is one, the other one, right?
I think
My
that's
question
it.
to you is that for anybody who's watching the show, the temptation is to buy small cap is real. Because small can become medium, medium can become big can become large. But purely from a risk reward ratio, do you think one should avoid buying into small cap funds, or it is still worth the bet?
See, I think the 2 points to that. See, small cap becoming mid cap becoming large cap. This hypothesis was true 10 years back, will be true 10 years from now. So you don't buy or sell stuff on a hypothesis which is a continual variable, right? 10 saal baad bhi I can make the statement that small cap will become mid cap. So that motivation for me to buy today can't be that hypothesis. But if you look at I have data till Jan 31st, pardon me. Of course, there's been outperformance of the small cap post that, is why I'm giving you my disclaimer. The underperformance with Nifty of the Nifty Small Cap 250 index, which is what is most relevant for a mutual fund investor, has been 5% per annum, 5.28 if I remember.
Can you explain that for us? Because it's an important point for our viewers. I mean, there's a frenzy in small cap stocks again and again. So what's your data saying?
January 31st, 5 years back.
Okay.
If you bought Nifty or Nifty Small Cap 250, Nifty Small Cap 250 would have left you poorer for 5 years of investing by 5% an annum.
And you're taking a high risk also, because when you're buying small cap, the volatility tends to be higher.
Absolutely. The beta is definitely higher in the small cap relative to Nifty. But the good news is when the rear view mirror shows ugly is when you should muster courage to buy it. So we increased our small cap exposure from an implied 16% to almost about 30% in Jan. Because if the rear view mirror is showing underperformance, can small cap underperform for 10 years? The answer is no. So that's one. And every time in the past this has happened over the last 10 years, that Nifty has outperformed small cap for 5 years. The subsequent 3 years for small cap has been outperforming periods.
Okay, so where is the rear view mirror ugly right now?
Mid caps, it's ugly.
Ugly.
Mid
Index
caps.
all-time high
At the
पर
lifetime
है.
high.
Index all-time high पर है.
No. Rear view mirror, you said. Sorry. The front view mirror is uglier for the 150 stocks.
Okay.
See, from a mutual fund investor, the top 100 is large cap, the subsequent 150 is mid cap. If you look at each individual stock and look at their businesses and look at Bloomberg analyst estimates and try and see what's the forward price targets, of course with some degree of more science, is a 12% target. Nifty is at 15. Small cap index is at 20%. So still there is a lot of relative outperformance on small cap possible, but the mid cap as a space can't be said in the same breath. Most of us generally say mid and small cap in the same sentence, but they're two very, very diverse groups. And a small cap, the largest small cap is now about 17,000 crores. 5 years back, it was just 8,200 crores. So small cap as an English word is hiding more than it's saying, because it was small cap, called small cap then, it's called small cap now, but 17,000 crore business is being called small cap. Is something which hit me harder when I was actually doing the math.
So you're saying be wary of mid caps.
Yes, the 150 stocks from a mutual fund investor.
So I'll wrap it up, and I don't want to get this one wrong. You are of the view that right now, if one is looking at small cap stocks, they have not reached Humpty Dumpty. One can still invest in them. Mid caps have reached Humpty Dumpty, and when it comes to large cap stocks, they're fit and fine.
Yeah, absolutely. One small little point. In small cap, never do index fund investing. Because small cap is all about eliminating those businesses which could be tricky. People generally buy an index, but the fund manager's relevance there is not to manage return, but to manage risk. So that's the only disclaimer I would like to put.
You live and learn so much of data, but so nice to have you. It's your
Sounds
first
more
time.
complicated than we thought it is, right?
Thankfully, that's what gives me a job.
Yeah, exactly.
Good to have you here in our studios, Feroz. We started off by talking about Jio Financial and then we deviated to a lot of very interesting data points. So it's been interesting to learn your take and your views on the overall market as well. All right, that aside, just a quick check-in as to what the index is up to at the current juncture, sub 19,300, and for the Sensex, absolutely flat. Yes, yet again, it is the mid and the small caps that are showing a little bit more of leadership. All right, let's move right on then and understand the outlook then when it comes to Keynes Tech. Talk a little bit about the business outlook, the margin levers, and what their outlook is when it comes to the growth prospects. We've got Ramesh Kannan, who's the MD and promoter, Jairam Sampath, who's the whole-time director and CFO with us right now. Thanks so much, gentlemen, for taking time out. I'm just going to pose a question on the back of the news that the company signed that MOU with the Karnataka government for projects worth about 3,700 crores. Can you share with us details?
The company has signed this MOU, you are right. The project cost is coming to around 1,500 crores as far as OSAT is concerned in the phase 1. And in the phase 2 and 3 put together, another 1,500 crores. That is how 3,000 crores is coming. Further, on the PCB plan, the company is planning to put 400 crores in phase 1 and 350 crores in phase 2. That is how the total amount comes to around 3,750. Between phase 1 and phase 2, there is a year and a half gap, and between phase 2 and phase 3, there is another 8 months gap. We are very confident that this will take this company into the next level. And we have spoken to a couple of our customers, and they have given us what orders they want to give us and how we want to take this forward. If there's anything you want to...
Yeah, so the idea was that we wanted to draw out a somewhat medium-term plan for this investment, so that when the policy is still very robust, we take advantage of this policy and put up capacities. Because the essence of putting up new capacities in an area like OSAT is to have lower burden, and the government policy provides for that. And because of that, we have now firmed up the plan for the medium term. That is, there are 3 phases: phase 1, 2, and 3.
Right. The other thing I wanted to discuss is who are these clients with whom you have signed a contract? What products will you be manufacturing from this particular unit?
It is too early for me to tell you all those things. However, they are the 2 large semiconductor companies we have approached, and 3-4 are mid-size and smaller size. They are all planning to have Making in India program and distribute it in India.
So how will you fund this project specifically?
Decided yet, but obviously large-scale projects need equity to be infused, and we are considering all options to fund this particular thing because it's a large number. And fortunately, the initial whatever little, let's say, recce that we have done, a lot of companies are interested in supporting our company into whatever projects that we are doing for expansion. So maybe sometime shortly we'll announce the exact mode of funding, but it includes obviously equity finance through investors and so on. So we'll finalize that shortly.
Added to that, government schemes are very good. As far as semiconductor, Government of India has got a semiconductor policy wherein 50% subsidy is there. The state also has got some contribution on that, on top of it. So all put together, we have cleared up the entire plan how to do, and we have discussed threadbare to get to the final stages.
Right. And now the government as well has taken steps to boost domestic manufacturing smart meters. So what is the portion of revenue coming from this segment and any new bids that you've placed?
We are closely to around 5% of our business comes from energy meters. And I think going forward, it will only go up because big numbers are being projected by all companies, and all of them are being fulfilled with contracts from the government side too. Over to you, please.
Yeah, absolutely. I think just supplementing this information, since the demand supply gap is large, we don't want to lose out wherever our strength point is. So we are approaching both contract manufacturing as well as ODM type of approach, so that of course we are a services company, so we don't have our own brand of products that we build. So from this perspective, we'll do contract manufacturing, that is turnkey EMS, as well as ODM, and we are in touch with many people. And at appropriate time, I think this is picking up speed this year, especially after the initial implementation has been done by the government last year for smart meters. So you can see a lot of actions from us and our peer companies going forward.
Right. Jairam, your EBITDA margins have been the best, right? 15% in FY23 amongst your peers, given the diversified portfolio that you have. Which are the high margin segments for you, and will that then be the focus area for growth for you going forward as well?
Essentially, the margins are determined by 6 factors. One of them is, of course, whether our batch size is low volume or high volume. We typically work in low to medium volume batch sizes. We don't do mass manufacturing products, and hence the chances of margins being better is higher. The other thing is the criticality of products that we manufacture. As you know, we've also talked about for the ISRO's Chandrayaan 3, the thrusters had the DC-DC converters manufactured by us. So something like that. So critical products gain better margins. The third thing is complexity. We typically manufacture complex products, be it railway signaling for something like short distance track circuits for metros, or any of these other even electronics for electric vehicles or medical electronics or industrial. So we make high complex products. So complex products typically gain a little higher margins than simple products too.
So do you think 15% margins are sustainable, and what is your expectations for FY24?
Designed a system by bringing a lot of manufacturing efficiencies, by bringing in new systems. So we strongly believe by design this is achievable and sustainable.
Yeah. So no, absolutely right. And you see, our profitability comes from 2 sources. One is the nature of business, and the other is essentially the operating leverage, which kind of goes up and down depending on the additional investments we make for new business, etc. So that's why we are saying that 15% EBITDA is a kind of a floor that you could expect in a business like ours. We already have an order book for 3,000 crores, so that probably qualifies in terms of EBITDA number if you were to just project existing costs onto it. So yes, based on whatever available data we have, I think this with scaling up to, we'll be able to hit this 15% plus EBITDA.
Right. Jairam, as you were mentioning about the Chandrayaan 3, are there any more such aerospace and defense orders that you have in the pipeline, and how is it that you see this segment growing on from here onwards?
Yeah, so I'm not at liberty to tell you exactly what it is, but there are, suffice it to say that ISRO is going to play a big role in the world market for, let's say, space vehicles and satellites and so on. So they have done their stage 1, which was developing capability. They've completed stage 2, which is developing vendors. And now they have done the stage 3, like the booster rocket. They have landed on the south pole of moon, which is like a statement saying that, yes, I know exactly, we know exactly how to do these things. So the stage 4 will lead to a lot of expansions. I can't really say directly, but I think they are proposing to work with a few vendors with whom they have had strategic relationships in the past several years. And they have seen these vendors' performance and how these vendors operate. So we are happy to be one of them, and we really will feel it is a privilege to do whatever it is that they ask us to do.
So talking about the EV segment, which is 10 to 15% of your revenue, where do you see this the next couple of years, and how are you seeing more orders coming in this segment?
Yeah, this is one sector which we will be getting in a big way. Our EV sector will have large orders. We are working with giants in this industry. And I'm sure and confident the days to come in, this will be one of the large components in my billion-dollar plan.
And just supplementing what Marcus said just now, see, it's not just the vehicle electronics we are focusing on, we are also focusing on the infrastructure side. There are many projects going on in the company, developing the charging infrastructure, which also will require to be developed along with the population increase of the EVs in the field.
All right, gentlemen, appreciate your time and thank you so very much for joining us. Well, you got what do we have ahead of RIL AGM? You got Reliance Jio Financial Services, or I would say Jio Financials. I mean, it's not Reliance, Jio Financial Services, which has recovered from the day's low. I mean, the same stock was just moving from circuit to circuit, circuit to circuit, and today it is moving on the upside, 2% higher for Jio Financial Services. Reliance AGM, and what should one expect specifically in terms of vision statement, specifics of retail, Jio, new energy business, and messaging in terms of whether the demerger will happen or not. Abneesh Roy, Executive Director with Nuvama Institutional Equities, joins us, and you've got Gurmeet Chadha Gurmeet joins us to give us a sense of what we should expect at an aggregate level. All right, gentlemen, good morning. Thank you for joining us. Who wants to start first?
Sure, I'll start first. Thanks.
Arey, anchor main hu yaar, let me decide. Okay. Abneesh, why don't you start?
Sure, thanks. So yes, we are definitely excited by the new launch of Reliance Retail on the U-Star. So first store has already come out in Hyderabad, and we expect around 200 stores opening in FY24. Our view is clearly Trend's Zudio format has been extremely successful, and that kind of a success now clearly is exciting other players also. And even Max has done a very good job there. So these two players have really created this sub-segment of the value fashion. So a lot of the products of the U-Star will be below 999, and most of those will be in fact below 499. The challenge here will be the fashion quotient has to be changing very, very rapidly. So that is the design aspect which has to be taken care of. What works for Reliance is already they are present in a huge number of stores. They have been in this business, but now it is much sharper pricing. And definitely in terms of the store expansion also, there will be competition. So every player is now entering this. Shoppers Stop also has entered this through their own brand, and all other apparel players also eyeing this. So it will be competitive. So in our sense, clearly Trend, the Zudio is a early mover advantage that's there. But for other players, it will be much higher competition, and definitely they'll have to go the extra mile because Trend Zudio is already a very big success there.
So Abneesh, in terms of the specifics here, do you think there could be a specific mention on demerger, whether it happens this time or next time, we don't know, but could he just set the tone in terms of sowing the seed that eventually that's where Reliance will go in terms of unlocking value?
Yeah, sure. So we'll also monitor the AGM speech and AGM, what happens there on this. But definitely investors have been looking forward to this. Obviously, with so much of consolidation happening in the hyper grocery, for example, most other players have either been acquired by Reliance or they have shut shop. So clearly in grocery, Reliance is extremely big. They have all these tie-ups with the different internet players also in terms of selling the stake to the key strategic players. And in other formats, also Reliance has done well. Obviously, it is India's largest physical retailer by a huge mile. So yes, there is a lot of hope that at some stage this demerger will be there, value unlock will be there. But without that also, if you see clearly, they are doing well. And the kind of expansion, the kind of white spaces they are closing. So in the value retail, U-Star was a missing link. And now we have seen that also. But yes, definitely in the AGM, we'll monitor what's happening on the value unlock.
Purely from an equity market perspective, do you think it's now only value unlocking and listing of the subsidiaries that's going to make the market happy? Gurmeet?
To me, Asha, sorry.
Yes, to you.
Yeah. No, I think it's both, Ashish. If you remember in 2019, they spoke about in 5 years they want to list the retail arm. And the way they have been doing acquisitions and considering that they just received $1 billion from Qatar QAI at about 100 billion valuation. That's almost double of where they initially did the first stake sale, which was pre-money. Also, I think I would be eagerly looking forward to the announcements in Geo Financial. Considering that's the latest one which got emerged. They're stitching together a good team. It's a great brand. They have a good capital base, and more importantly, they have the technology and data analytics. So this is what you need, for any financial services to do well. I would also be more interested in what their plans, capex plans are on the energy front. Mr. Ambani has hinted at eventually producing green hydrogen at almost at $1. So one concern of the market which has resurfaced in last 12 months is again rising debt. Are they doing too much capex again? Something similar to what they did in Geo from 2013 to 18. So that I think they would want to address. And this is, if I can call that, it's a little early maybe. It's our version of the Berkshire, our own version of the Berkshire AGM, one of the keenest events looking forward. So I think the market would be interested more in the operational performance, especially on the capex and the debt side, and obviously the value unlocking of all the three arms.
What, Gurmeet, to your mind, could be the market cap of Geo Financials 3 to 5 years from now? I mean, ultimately, if it has a balance sheet which is rich, it has data which is magnificent, it has reach like no one has, and it has a brand on top of it. Where do you think a business like this could be in terms of a pure market cap? I mean, it could be a outlandish number, but if you have to, let's say, throw a dart, what could be that number?
I think looking at, if I just derive it, if you look at their lendable net worth, I'm not talking about the total net worth, and if they go organically, they will probably hit about 80,000 crores to 1 lakh crore kind of a loan book. And inorganically, I'm sure they will. The way they have done in retail, they would. So I think they will probably get a similar valuation of 4 or 5 multiples, which something like a Bajaj Finance or a Chola gets, considering low cost of funds, the team they are stitching, the brand, etc. So I will not be surprised if it's between 4 to 5 lakh crore kind of a valuation in, let's say, 4 or 5 years from now. And I'm including some, as I said, inorganic acquisitions. Purely through organic route, which I don't think so they would pursue, it may not go to 4 or 5 lakh crores because you may lend too much, but your collection infra, both physical and digital, takes time. Your credit underwriting skills get evolved. You have to see one bad credit cycle to see how good irrespective of whatever be your experience. Only once you experience it, you figure out. So I think considering that they will go inorganic, I think anywhere between 4 to 5 lakh crores in my view.
Avnish, anything that you think the street will closely be watching out for when it comes to Reliance Retail, particularly that recent investment?
Yeah, I think 2-3 things on the used. What will be the longer term plans? We know for FY24 they are targeting 200 kind of stores, but what will be the longer time frame here, and how they will differentiate versus a Zudio or say a Max? Second will be on the JioMart e-commerce. How are things panning out there, because clearly a lot of the other e-commerce players have started focusing on profitability, and in terms of the initial plans, where are the deliverables, monitorables there? So those I think will be the key points we'll be looking forward to in terms of more clarity. And on the last point will be on the jewelry. Clearly we have seen Titan do so well. Now CaratLane also now almost 98% stake Titan has. So what will be the plans for Reliance in those kinds of e-commerce platform? They have the overall e-commerce, but focused on say jewelry, etc. What will be the plans there?
Sabnish, 3 years out, what to your mind could be the market cap of Reliance Retail? Now, whether that happens because of listing or whether that happens because of another PE deal, but what to your mind could be the derived market cap of Reliance Retail?
No, I will not be able to comment on that because we don't cover that. Obviously, it is part of the Reliance Industries. So those will be the right analysts to speak to. But yes, in terms of growth, in terms of scale, obviously Reliance is there at the top in terms of most of those top 2, top 3, definitely. Plus, as I said, a lot of consolidation has happened, and definitely we have seen in the physical grocery, for example, only Avenue Supermart is the large player left. Trends, Star Bazaar is also picking up. So we are seeing consolidation benefits clearly. And in the e-commerce also now most players are focusing on profitability, which also implies that the peak of the discounting is behind us. And now it will be a more profitable and a sustainable growth for most players. And Reliance obviously is the big daddy there. So difficult for me to comment on the valuation part, but definitely this will be a stock which I think investors will be clearly awaiting. And also on the tie-ups with the Kirana, for example, where can that value creation happen? Because that's a huge, huge opportunity.
From now, we shall get answers to all of this as well as a lot more clarity on the news and announcements. Abneesh, Gurmeet, pleasure having you both on board. Thanks so much for taking time out and joining in. With news that the index is currently at 19,283, we'll take a very quick break. Be right back. Chartbusters and lots more market updates when we return.